Imagine your retirement savings. Your RRSP is quietly being drained day after day without you even realizing it. You're working hard, contributing faithfully, but a silent thief is at work, stealing from your future. Today, I'm going to expose the hidden culprits robbing your RRSP and show you exactly how to stop the bleed, protect your nest egg, and accelerate your path to a truly secure retirement. This isn't just theory, it's a silent crisis impacting millions of Canadians right now. You diligently contribute to your RRSP, believing you're building a comfortable retirement. But do you ever get that nagging feeling your savings aren't growing as fast as they should? Or worse, that you're barely keeping pace with rising living costs? Consider someone like John. He faithfully contributed to his RRSP for decades, trusting his financial institution. Yet when he finally looked closer, he was stunned to discover high hidden fees and the relentless march of inflation had quietly eroded a significant chunk of his hard-earned gains. His dream retirement looked much less comfortable than he'd imagined. This isn't an isolated incident. It's a widespread problem, leaving countless Canadians with less than they deserve. Have you ever felt this way about your own savings? Let me know in the comments below. In this video, we're not just going to highlight the problems. We're diving deep into 10 critical ways your RRSP might be losing money, and, crucially, concrete, actionable strategies you can implement right now to fix them. From unmasking invisible fees to leveraging every dollar you contribute, we'll ensure your retirement fund is not just protected, but future-proofed. Let's start with trap number 1, the invisible money sucker, those management expense ratios, or MERs, and other hidden fees. These aren't just minor deductions. They are insidious costs that compound over time, silently siphoning off your potential returns. They are deducted directly from your investment before you even see your balance, making them easy to overlook. Imagine you have a $50,000 RRSP. A seemingly small 1.5% difference in MERs might not seem like much today, but over 25 years, that difference alone could cost you over $30,000 in lost growth. Think about it. That's money that should be compounding for your future, not someone else's bottom line. To tackle this, pull out your RRSP statements. Look for MERs, administration fees, and trading commissions. Compare these costs with low-cost alternatives like exchange-traded funds or ETFs versus the often higher fees of traditional mutual funds. The benefit? More of your hard-earned money stays exactly where it belongs, working for you, building your financial freedom. But even if you conquer fees, there's another hidden force constantly at play, silently eroding your wealth. That brings us to trap number 2, inflation, the silent thief. Inflation is the relentless increase in the cost of goods and services over time. If your investments aren't growing faster than inflation, you're not gaining ground, you're actually losing purchasing power in real terms. Let's say your RRSP portfolio earns a respectable 4% return in a year, but inflation for that same year is 5%. What does that mean for your buying power? You're effectively losing 1% each year. Your growth is an illusion, like trying to run up a down escalator. To fight back, you need to ensure your RRSP investments are structured to outpace inflation consistently. This often means having a well-diversified portfolio that includes growth-oriented assets like equities, which historically have proven to be one of the best long-term hedges against inflation. Protecting your retirement lifestyle means ensuring your money grows faster than the cost of living, preserving the buying power you'll need when you stop working. But even with the right fees and inflation-beating investments, many Canadians fall into common investing pitfalls. Which leads us to trap number 3, subpar returns from common investment blunders. Many investors, despite their best intentions, make fundamental mistakes that severely hinder their RRSP's growth. This includes chasing the latest market trends, making emotional buying or selling decisions based on fear or greed, or simply failing to regularly rebalance their portfolio. Picture a scenario during a market downturn. Many Canadians panic, selling their investments at a loss, only to miss out on the inevitable market recovery that follows. This reactive behavior can decimate long-term average returns, leaving your RRSP years behind where it should be. The immediate action here is education and discipline. Arm yourself with basic investment principles, commit to a long-term perspective, and resist the urge to make impulsive decisions. Stick to your predefined investment plan. This isn't just about avoiding losses. Smart, disciplined investing can dramatically boost your RRSP's growth, leading to a much larger, more secure nest egg. Yet, even smart investors sometimes overlook a critical way to boost their RRSP. That's trap number 4, missing out on free money by underutilizing contributions. Are you leaving significant tax deductions and future growth on the table? Many Canadians are, simply by not maximizing their annual RRSP contributions, especially neglecting unused carry-forward room from previous years. Imagine you have $8,000 of unused contribution room from the past few years, and you decide to finally use it. Depending on your income bracket, that single contribution could result in a tax refund of hundreds, even thousands of dollars. And what could you do with that refund? Reinvest it right back into your RRSP, creating a powerful snowball effect. To seize this opportunity, check your latest Canada Revenue Agency Notice of Assessment. Your RRSP deduction limit is clearly stated there. Make it a priority to maximize your contributions each year, especially if you have accumulated unused room. This simple step can maximize your tax benefits and significantly accelerate your savings growth, helping you build a retirement fund much faster. But be warned, while contributing is good, taking money out too soon can be a financial disaster. Which brings us to trap number 5, the tax time bomb of early withdrawals. Dipping into your RRSP before retirement isn't just costly, it can permanently derail your long-term plan. Any money withdrawn is subject to immediate withholding tax, and worse, you permanently lose that contribution room. It's a double hit that many Canadians don't see coming. For example, if you withdraw $10,000 from your RRSP for an emergency, you could lose anywhere from 10% to 30% or more instantly to withholding tax, depending on the amount and your province. And that $10,000 of contribution room, gone forever. It's a double hit that many Canadians don't see coming. For example, if you withdraw $10,000 from your RRSP for an emergency, you could lose anywhere from 10% to 30% or more instantly to withholding tax, depending on the amount and your province. And that $10,000 of contribution room, gone forever. Your RRSP should be viewed as your sacred long-term retirement savings. For shorter-term goals or emergencies, explore other options like your tax-free savings account, TFSA, which allows tax-free withdrawals and replenishes contribution room. Preserve your tax-deferred growth and avoid those hefty penalties, ensuring your nest egg is robustly there when you truly need it for retirement. But even if you avoid early withdrawals, your RRSP isn't something you can just set and forget. Enter trap number 6, the set it and forget it myth. Your RRSP isn't a passive account that just magically grows. Without periodic review and rebalancing, your investment portfolio can slowly drift from its intended risk level and allocation, exposing you to unnecessary risks or missed opportunities. For instance, if a specific sector or asset class performs exceptionally well, it might grow to dominate too large a portion of your portfolio, making you more vulnerable to downturns in that area. This means your retirement fund might suddenly become riskier than you ever intended, jeopardizing years of careful planning. The immediate action here is straightforward. Schedule an annual review of your RRSP. Check your asset allocation, analyze its performance, and ensure it still aligns perfectly with your evolving financial goals and your current risk tolerance as you age. This regular checkup helps maintain an optimal portfolio that stays aligned with your financial trajectory, minimizing potential losses and maximizing appropriate growth. However, a common mistake often overlooked even during reviews is the illusion of diversification itself. That's trap number 7, the illusion of diversification or concentrated risk. Many Canadians believe they're diversified simply because they own a few different mutual funds or stocks. However, they might actually be over-concentrated in one sector, a specific geography, or even a single asset class, exposing them to far more risk than they realize. For example, if your RRSP is heavily invested in Canadian resource stocks, a significant downturn in that specific sector could devastate your portfolio, even if other parts of the global market are thriving. True diversification acts like a safety net, protecting you when one area of the market struggles. The crucial step here is to thoroughly review your holdings to ensure true diversification across multiple asset classes, think stocks, bonds, even real estate, across various geographies, and across a wide range of industries.
Avoid the temptation to put all your eggs in one basket. By doing so, you can significantly reduce risk and smooth out your returns, making your RRSP far more resilient to inevitable market fluctuations and robustly protecting your capital. But choosing the right mix of investments is also paramount, which brings us to trap 8, picking the wrong RRSP investments or misalignment. Selecting investments that don't match your personal risk tolerance, your time horizon, or your specific retirement goals can lead to immense anxiety, impulsive decisions, and ultimately suboptimal returns. Imagine you're 5 years from retirement and your RRSP is heavily weighted in volatile, high-growth tech stocks. A sudden market correction could wipe out years of gains right when you need stability most. That's a recipe for sleepless nights and potential financial distress. To avoid this, first, deeply understand your personal risk tolerance and how much time you have until retirement. Then, choose broad market ETFs or well-diversified mutual funds that align with your long-term strategy, rather than attempting to pick individual winning stocks. This approach allows you to invest with confidence and significantly less stress, knowing your choices are precisely aligned with your personal financial profile and your unique retirement timeline. But who you trust with your money also plays a huge role. That brings us to trap 9. Don't let your bank rob your RRSP. DIY versus advisor costs exposed. Many Canadians rely solely on their primary bank for RRSP advice and products. Often without realizing this can expose them to significantly higher fees and a limited range of investment options. Consider this. A full-service financial advisor at a traditional bank might charge management fees of 1% to 2% of your assets annually. However, if you're comfortable managing a relatively simple, diversified ETF portfolio yourself through a discount brokerage, your costs could be as low as 0.2% or even less. Over decades, that difference translates into thousands, even tens of thousands of dollars more in your pocket, not theirs. It's essential to evaluate whether a full-service advisor is truly worth their fees for your specific needs. Explore low-cost robo-advisors or self-directed brokerages if you're comfortable taking a more hands-on approach. Taking control of your fees means directing more of your money towards your retirement and less into someone else's pockets. And finally, how do you protect all this against the inevitable ups and downs of the market? That's trap 10. Future-proof your RRSP, strategies to beat market volatility and protect your nest egg. Without a solid strategy for navigating market downturns, volatility can easily induce panic, leading to hasty decisions like selling at a loss, which can severely jeopardize your long-term growth. Here's a powerful example. During a market correction, instead of panicking and selling, consistently investing through a method called dollar-cost averaging allows you to automatically buy more shares at lower prices. This simple strategy significantly pays off when the market inevitably recovers, turning what others see as a crisis into an opportunity for growth. To future-proof your RRSP, develop a personal investment plan that explicitly includes strategies for market volatility. automate your contributions to effortlessly leverage dollar-cost averaging, and, critically, resist the urge to check your portfolio daily, especially during rough patches. This allows you to ride out market storms with confidence,
transforming volatility into genuine opportunity and safeguarding your long-term growth and peace of mind. Every single day you ignore these 10 RRSP traps is a day you're letting thousands of dollars quietly slip through your fingers. Your future self will profoundly thank you for taking action today. Remember that old saying, the best time to plant a tree was 20 years ago. The second best time is now. The exact same principle applies to securing your financial future. Don't let your hard-earned money simply vanish. Take these concrete steps, regain absolute control, and accelerate your path to a truly secure and abundant retirement. If this video has genuinely opened your eyes to how you might be unknowingly losing money in your RRSP, please hit that like button right now. Subscribe for more essential Canadian personal finance insights, and in the comments below, tell me, which RRSP trap are you going to tackle first? Your engagement helps us reach even more Canadians who desperately need this crucial, life-changing information. Your RRSP isn't just another account. It's your personal key to a comfortable, stress-free retirement. By truly understanding and actively avoiding these common pitfalls, you're not merely saving money, you're powerfully building the future you authentically deserve. Take decisive control, vigorously protect your nest egg, and ensure that your retirement dreams don't just remain dreams, but become your vibrant reality. You possess the incredible power to stop the silent loss and truly start growing your wealth, beginning today.